Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing exit strategies, how to exit your funds smartly so that you maximize the output. Now, Mrin, specifically, I want to talk to you about systematic withdrawal plans. How important are they when we are talking about exiting funds where we may not need the entire lump sum money upfront?
Yeah, so very interesting. I've seen that SWP or systematic withdrawal plan is something that's gained a lot of traction in the last 1 year. And I'm often asked about it as a route to creating wealth, right? So I would like to clarify a couple of things. SWP is a product where you basically want to take out money on a regular basis. So it is the opposite of the SIP where you're investing. Here, what you're doing is that you're trying to set up a regular cash flow. So it's a product for regular cash flows. Now, couple of things that you have to keep in mind in the SWP, right, is that, see, whenever you want regular cash flows, it has to be from a product which is growing at a stable rate and which has surety of returns, right? Now, I'm seeing a lot of people talking about setting up SWP from equity funds, which is a little concerning for the reason that equity funds can be extremely volatile. So, for example, let us say that you have some amount, let's say 1 crore, and you think of setting up an SWP, but then the markets fall by 10-15%, as we saw earlier this year. So everything is going to go out of whack, right? I mean, all your calculations and everything are not going to hold good, whatever you've done, right? Like if you started with 1 crore and you're removing some amount every month and the markets fall, your 1 crore is going to come down, let's say, to 85-90 lakhs. Obviously, all the calculations that you've done are going to change, right? So very, very important that, you need to get the reason for doing your SWP correct. That first, the SWP is meant to generate regular cash flows. It has to be done from an instrument which gives stable returns like debt funds and certainly not equity funds. And point number 3, the SWP also needs to be planned well. And I'll explain this through 2 examples, right? So
yeah, so Mrin, so I get your point. What you're saying is that don't do SWPs directly from equity funds because equity funds can be volatile. Let's take an example. Let's say that, someone is looking at regular income after retirement. Let's say they've got a corpus. They've got either a 1 crore or 2 crore corpus. How should they plan the exit via the SWP route then?
Yeah, so 2-3 things. See, now if you make an investment, let's say, into a debt fund and you start the SWP right away, it's like you just getting your money back over a period of time, right? So I think first thing is that you should actually invest in a debt fund for, let's say, at least a 3-year period and then start the SWP, because then you've built some amount of gains over the last 3 years, basically. So that's the first thing to be kept in mind. Second is you have, I think, some SWP calculators that are available online, but actually I would actually suggest that please plan this with a financial advisor because it's not that easy. I'll give you an example. Let's say that you start with a 2 crores corpus and you want to withdraw 1.5 lakhs per month. And I'm assuming return on investment at 5%. I'm looking at a post-tax return on like a short duration debt fund. Okay. So you've got a 2 crores corpus. You've put that money in a short duration debt fund and you want to withdraw 1.5 lakh rupees every month. If you do the cash flow calculation, this money is going to get over in 16 years, right? Let us say you wanted to plan for the next 20 to 25 years. You're actually going to fall short because the money is only going to last 16 years. So there is another plan that you can do with the SWP, which is that you invest part of the money. So in the same example, you invest 1 crore and in the short duration debt fund and you start the SWP. Same way, 1.5 lakhs every month, it's going to last you for 7.5 years, right? Now, the balance 1 crore, you can invest into a balance fund for about 5 years, move that money into a short duration debt fund, and then start the SWP. So what happens with that is that then you are able to have the SWP running for about 19 to 20 years. And that way, you're able to meet your requirement of getting that amount on a monthly basis, because what you've done is that the first part of it, you've invested, you've ensured that you're getting your cash flow for 7 years. The balance amount you invested into another instrument to grow the corpus and then start the SWP on that, right?
Oh, so this is interesting. Basically, you're breaking this up. You're letting one part of that corpus continue to compound in an equity instrument, and you're remaining, the other half of that corpus is being put in a debt instrument, which is more stable, and then you do a systematic withdrawal plan from the debt portion of it. Got that? That makes a lot of sense. Mrin, we are trying to just squeeze in some viewer queries here as well. If you can, quickly answer these. Because viewers have been writing in saying they have some doubts on mutual funds. So I want to take this query that's coming up on coming from Sam on Instagram. He's saying, what is the difference between value, growth and momentum funds? And how should I look at their composition in my portfolio? Do I need to rebalance? Do I need to add them? What should I do? Mrin, new fund categories, many of them on the passive side.
Yeah. So the value funds are funds which invest in stocks, which are basically trading, below their true value, basically, and they're expected to essentially grow in the long term, but they're undervalued at this point in time. Growth stocks are, of course, from sectors that are expected to grow well over a period of time and give you sustainable growth. And momentum investing is all about investing in what is basically trending, right? So in a very, very simple way. Now, what should be the allocation of each of these categories in your portfolio is totally dependent upon the risk that you want to take. Certainly momentum, followed by growth, followed by value. That is your high risk to lower risk. So if you want to take a very high risk, if you're able to take high risk, then you could have a higher amount in momentum. If you don't want to take high risk, if you want to be more conservative, you could do value funds. It's all dependent upon what is the sort of risk that you want to have in the portfolio, basically.
Okay, absolutely. So that, I guess, is the golden rule for rebalancing. First, assess your own risk profile, your own requirements and your goals, and then look at your portfolio. So final thoughts, Mrin? I mean, this is a very helpful conversation. So just recap this for us in a nutshell. Exit strategies and the question of exit via an SWP versus lump sum exits. Just what should be a holistic framework to follow?
Okay, so first and foremost, look at exiting only if you're close to a goal or if you're looking at doing rebalancing. That's point number one. Secondly, lump sum versus SWP. So lump sum, of course, you can withdraw and then you can design like whatever sort of strategy you want for your withdrawals. But there does exist a systematic withdrawal plan, which is actually a very good feature that's there in mutual funds to get regular cash flows. But point number one, always, I would say, of course, do it in a debt fund because equities are really, really volatile. And secondly, plan it well. Use the SWP calculators online to figure out as to how long the money would last based upon what is sort of withdrawals that you're doing. And as I said, if it's really not tying in with your time frame, then see how you can work with a financial planner or get someone to basically design it out for you.
Okay, all right, Mrin. Thank you very much for joining in. Sometimes, something that sounds so logical and commonsensical escapes our mind. So it's important to discuss it and put it out there for everyone's reference. Thanks very much for joining in and sharing your thoughts with us. Well, folks, that's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful, simple and systematic, not just when it comes to your investments, but when it comes to your exits as well. Keep sending us your feedback, comments and queries. We'll see you with another conversation next week.
Let's Talk Money